Hello and welcome back. So Apple was very positive after hours, and that actually reversed right now. It's negative 2.3% after hours, about $160. Let's see what happened. And you can see that in this article here, Apple shares dip after company warns of a possible 8 billion hit from supply constraints. This is what it caused the drop. Now, Apple's revenue grew nearly 9% year over year during the quarter, ended in March. Shares fell nearly 4% in extended trading as the CFO actually warned of these supply constraints. But what I love to see is that the tech giant Apple authorized $90 billion in share buybacks. And if you know me, whenever I see something of that sort, I absolutely love it. This is exactly what I want from companies of that sort. Buy back their own shares, as long as they are cheap, of course. Now, Apple's revenue grew 9% year over year from the previous quarter, that is. And it's showing strong growth, and that's a very cool thing, of course. Yet, it fell 4% after they announced this kind of constraints that they're having, the supply constraints. Now, the EPS was 1.52 versus the estimate of 143. That's pretty great. Revenue 97.28 versus 93.89. That's a 8.59% year over year increase. That's pretty nice increase for a company of Apple's size, by the way. And iPhone revenue has increased, services revenue has increased, other products a little bit less here. Mac revenue more, iPad revenue more than expected, and gross margins, look at these margins. Wow, 43.7. So this is stellar, pretty much. I love what I'm seeing here. And another interesting thing, and another reason why the stock may have been going down, is that Apple did not provide a forecast, so there's no guidance. The company hasn't really provided revenue guidance since February 2020, and so they are citing uncertainty tied to the pandemic, and so this kind of scares people that may want to take a position with Apple. And so $90 billion in share buybacks, very nice, and increased its dividend by 5% to 23 cents per share. Now let's take a look at Apple and the stock and see whether it's a buy. Now the PE ratio for the company is sitting at 27.8. Now it may seem a little bit elevated, but it may not be, because what we care about is the free cash flow and how it translates to how much we should be paying for the company today. We're gonna see that with our discounted cash flow model. But look at the outstanding shares count going down and down and down. I love to see that, and it's gonna get down even more after the company announces $70 billion buyback. Now the company is a $2 trillion company, so 70 million or 90 that was. I believe it was 90. I may be mistaken. 90. So 90 million is not that much when you compare it to the market cap, but it's like what 5% or something, 5% or something. But still, I mean, it's still outstanding shares going down, and I absolutely love that. Now, free cash flow to total liabilities, the company has a lot of free cash flow, as we will see, and the 5-year revenue growth has been increasing, net income growth increasing, free cash flow growth increasing, and total equity growth has been going down. We have talked about it. I have made a dedicated video talking about Apple. I'm not gonna talk about this one again. It has to do with the return on equity. If you are interested, I'm gonna leave a video link in the description, not in the description box actually. I'm gonna leave it in the end of the video. It's gonna be easier to just click and go there. So this is pretty much by design. The fact that the company has a total equity growth of minus 52% and it's going down, and you will understand why if you actually watch the video that I'm pointing at. So, let's take a look at the actual. I want to see the stock evaluation tool here because I want to see what makes sense right now. And so, Apple's revenue growth seems to be still increasing pretty nicely. Yet, I'm gonna go relatively low. It may not be that low actually. It's actually not that low. I'm gonna go. Let's try this, and we may try another one actually, just for the sake of exercise. So the net income margin is let's just say 21, 23, 25. Free cash flow margin, again similar values for Apple pretty much every year, 105, 110, 13% of a return. Let's hit calculate and see what we're getting out of this one. Now out of this one we're getting that it's only the high estimate that actually makes sense with the 21% revenue growth. That's definitely quite some. The company has only achieved that in 2021, so yeah, this is actually a large number, and even this is a large number really. So yeah, we can't go that large, so I'm gonna go a little bit lower here. I'm gonna go 8, 10 and 12. which I think is a little bit more normal to what the company may achieve. Now let's hit calculate. And now we're looking at a company that is overpriced for what it is again, and it doesn't really look like a buy for me today, because I do want to be getting my companies at a lower price, at a good price, and not overpay for them. I can wait for a potential decline, or if it doesn't happen, I can just get another company. I mean, there's all sorts of companies, and some are better than the others in terms of price. But a fantastic company, but the price must match my expectations, and so it must match my calculations here. So if Apple were to fall at around $100 at some point, which you may be thinking that it never will happen, but you never know. All the companies have slumps and downturns and some downtrends even, and it could go down for a while. So it can happen. Don't be too sure about this. And yeah, so I think the company is doing well. I mean, this was a stellar earnings report. I loved it. Yeah, some things may get a little bit worse, but the company seems to be doing very nicely. Maybe the issues that are having right now, maybe it will cause a decline in the stock price for the next quarters, and then maybe, just maybe, we can reach my estimates here. But right now, I wouldn't buy the company. I'm on the sidelines. I'm watching for it, watching to get a better price, but I'm not entering right now. It is expensive for my taste. And thank you again for watching this video. I hope you enjoyed. Please leave a like and subscribe if you enjoy this kind of content, and I'll see you in the very next one. In the meantime, take a look at the video that I mentioned earlier, in which you can actually exactly understand why Apple is decreasing their equity and how they're using it for debt in order to increase the return on investment. So basically increase the return on equity for stockholders. So thank you for watching again, and I'll see you soon. Bye bye.